Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracy Reineck, and this week I'm going solo to talk about the most shocking stock charts you've ever seen, or at least I've ever seen. And I've come across these recently in the last couple of weeks here in the summer of 2024, and I couldn't actually believe what I'm seeing. I've talked about them a couple of times, a few of them on the Value Investor podcast, because they keep showing up in my value stock screens. But now I wanted to share them with you here on the Market Edge. So if you're listening to this, I'm going to do my best to describe these shocking charts, but you really should go and watch it because I am going to share my screen and show the charts on YouTube. So go watch this podcast on our YouTube channel. It's zacks.com/YouTube. Otherwise, like I said, I am going to do my best to describe the charts, but these are companies and stock charts where the stock is sold off, but the earnings are going the other direction. The earnings still look good and are going up even. So what's happening? Why is there this massive disconnect with these stocks? And I have to say, when I was looking around for the shocking charts I wanted to include on this podcast, I had my choice of many. It wasn't that I struggled to find 5 charts that I could cover here. I had 10 or more. And if I kept looking, I'm sure I would find 20 or more of these same charts. So some of these may be value stocks now with that nice earnings growth, but some of them are still just basic growth stocks that have come down to earth after the pandemic. Now, many of these were what I call pandemic winners. So they were well-known, very bought stocks during the pandemic. Many of them were owned in various growth funds, like Cathie Wood's ARK Innovators portfolio or Innovation. I forget what she calls it now, but you know the one, her flagship, the ARKK ETF, that soared to new all-time highs in 2020 and part of 2021 before coming all the way back down to earth. And some of the reasons it's come back down to earth is because of what was happening with these stocks that she owned. A lot of these kind of technology growth stocks, these are the innovators. These are the Zoom videos, the Palantirs. Some of those stocks, they have basically plunged, and are what I consider and call normalizing on a PE basis or, a valuation basis, but the stocks remain depressed. People aren't buying them, even though they've gotten much cheaper. And as I said, the earnings are expected to rise. So this is like a weird conundrum. That's why I call these charts shocking, because it's pretty rare to see charts on the price of consensus, because that's the one I'm going to show you, look like this. And you kind of have to scratch your head. I'm sure Cathie Woods and her team are, they're going on Zacks.com. They're looking at these charts themselves and saying, what's up? We still own these because look at what these earnings are expected to do. And now the stock is cheap, but the street doesn't care. It is totally rejecting these stocks right now. And so what are they? Let's dive right in, because I'm done talking. Let's just look at these shocking charts. Okay, the first one I chose is Twilio. This was a big pandemic winner. You can see shares topped out, it looks like in 2021, and then the decline starting in 2021 into 2022. Looks like it has bottomed, but it's just bottomed and kind of meandering along. But look at that earnings. You can see up and to the right for 2024, 2025, and then even we're starting to get some estimates in for 2026. They are profitable. They are making money. You can see on the left-hand side over here, looks like maybe $3.75 or so for 2026 a share. And so that's good. I look for that. I want to make sure that my company has positive earnings and is making that. But I looked at the 5-year stack now, Twilio down 54% over the 5 years. So that is before the pandemic hit. So it's lower than even the pandemic low here. Year to date, even, it has gone a little bit lower here year to date. Looks like it's like kind of tapping around 50 a couple of times over the past 2 years, but year to date, it's down 21%. Now, Twilio, if you go to their site, they say they are a customer engagement platform, and they have customers in 180 countries. So this is a legit business, but it is on the tech side, and this is in the doghouse. But why is it? I don't know. But those earnings are shocking compared to where the stock is. So that's Twilio, ticker T as in Tom, W, L as in Larry, O. Okay, so I want to look at the next chart. This one I have talked about on the Value Investor podcast because it got into a single digit PE, and it's PayPal, ticker PYPL. Now this one looks kind of similar to Twilio, but not quite as shocking because some of the estimates for 2024 and 2025 have come down this year, but they're starting to rebound and go the other way again. And we are still seeing year over year expected earnings growth. If it happens, we'll see. And it looks like the analysts who are now giving some estimates for 2026 are looking just as positive again. Nice earnings growth off of the last prior 2 years. But this chart looks very similar to Twilio's, right? If you didn't know on the actual chart where the stock is gone, not on the earnings, you might think it was Twilio because this one also peaked in 2021, started the big slide, kind of tried to bottom in 2022, but didn't until the fall of 23 when we did get the big stock rally. This stock has come up off of those lows, but it too remains pretty much in this narrow trading range, depressed, not really going anywhere. So 5 years, PayPal is now down 41.8%. And just to compare, the S&P 500 is S&P 500 is up 86% during that time period. So this one is down 41.8 after it was a beast for all those years after it was spun off of eBay. But one big collapse can wipe out years of gains, and we're seeing that with PayPal and Twilio as well. Year to date, the shares are up, but only 3.5%. S&P 500 up about 15% year to date, so it's still underperforming. But like I said, those earnings are not. Those earnings are rising. Now, just for fun, I want to look at the detailed estimates to see, okay, it's trading at 14 times now. So it's a little more expensive. And that could be because maybe some of the earnings are still holding up pretty good. This year, expected to decline 18%. They made $510 last year, expected to make $416. But then this is where we are going to see the growth again, up another 9.8% next year to $456. So this year is the problematic year, but that's why the stock has already been hammered. It's kind of just sitting down there. But next year, maybe we'll get the rebound, but the street is not really believing it with PayPal. So that's why the shares remain depressed, even though they're in value territory. It is a Zacks number 2 buy stock right here. And you can see because the analysts, where is it? Up. We got some earnings estimates revisions higher. None are lower. So maybe they were getting a little too bearish on PayPal here. But this is what I mean by shocking chart, because this one, again, doesn't really make sense when you look at it. It might make sense from a value point of view, but with some earnings growth for next year, another 9% for next year, and then the bullishness for 2026, we'll see. But that's PayPal, ticker PYPL. Then I wanted to switch over to another Cathie Wood stock here, Roku, This is the smart TV streaming platform. And this one, similar story, peaked in 2021, big decline into 2022, not really going anywhere in 2023, had a mini sell-off again into the fall, has rallied a bit, but now has pulled back once again. That seems to be the story now. I shouldn't laugh because this is hard times if you're shareholders in any of these companies. 5 years, it's down 62.3%. That's very terrifying for most long-term investors. Year to date, though, it has weakened considerably again, and it's now down 36% year to date. So again, Roku, with the huge sell-off, but you can see up and to the right with some of these earnings. And let's just look again. I'm going to look at the detailed estimates again. So this year, earnings expected to be up 61%, but they lost $5.01 last year, expected to lose just $1.94 this year. Another 23% earnings growth for next year, but a loss of $1.48. I do like companies that have the positive earnings, so this one would not be for me. But if you are a growth investor and you're looking just for that earnings growth, well, here it is. And the stock, again, remains depressed. Now, sales growth, you can see up here, 12.5% this year, 12.1% next year. That's nice double-digit revenue growth going on, but still not earnings positive, and we're still going to get their next earnings report coming in. But this chart, pretty shocking on Roku, which was an extremely popular stock during the pandemic for obvious reasons, because we were streaming and watching everything while we stayed inside our houses. But has it come down enough? Is it cheap enough now to buy this earnings growth? The street is saying no, but this is one definitely to keep an eye on. Okay, that's only the third shocking chart. The next one, I was surprised at. I kind of just said, hey, maybe I should take a look at this one. It was a big pandemic winner, but I had no idea what was going on with the earnings, and it's Etsy. So this one is a little bit different on the earnings outlook. It is still elevated earnings, but small growth year over year and not as much up and to the right. Just kind of, they're going to make around this and they're going to keep making around this, but not as much earnings growth. But still pretty shocking given the sell-off in the stock. It peaked in 2021. We were all buying items off of Etsy. In the beginning of the pandemic, it was masks, but those homemade masks went out the window, and then we were buying other things off of Etsy. But as like I've been saying with everything, the shares started to sell off in 2021, continued in 2022, but it's been a slow decline since then. And now it's trading at the 5-year lows. Now, this stock is not in the red, and it is still slightly above its pandemic lows. So that's good for the shareholders here. 5 years, the shares are still up 20%. But remember, that is below what, the S&P 500 is doing, up 86% during that same period. Year to date, however, because the shares continue to sink, it's down 21.7%. I do feel with some of these charts that if you had hung around and you stuck it out, or maybe you bought because the stock appeared cheap at the beginning of this year, 2024, but then the stock continued to sell off, so you got out, that a lot of the hands are being washed out again. It's another round of washing out, and maybe these stocks haven't really bottomed yet. So we may have another period down with some of these, and maybe these charts will get even more shocking. But a lot of these stocks will just become the value stocks that they, were waiting to be. There is always this period in between when growth kind of taps out, but the stock is not yet a value. It's like the no man's land is what I call it. So the growth investors aren't really interested, although with a lot of these, they really still should be, because the earnings are growing with these stocks. But it's not cheap enough yet to lure in the value investors. So we're waiting for it to really bottom out completely, and then we will at least get the value investors. But the shocking thing is that the growth investors are ignoring these. They've moved to the sidelines even with the growth. So this year, Etsy earnings growth just 2.5%. But look at next year, 2025, 14%. So a turnaround if it happens. Estimates are all over the place. We do have one hire in the last 7 days for both this year and next year. So that's a positive, but some people cutting, adjusting. There's been a lot of adjustments. You can see PE on this one, Etsy 25.7. So is that cheap? No, not really. So this is what I mean about a no man's land. There is some earnings growth in there, but maybe not enough for the growth investors to dive in. And the growth story may be petering out a bit. So growth a little bit out of favor, but it's not yet cheap enough for the value investors to say, I'm going to take a chance on that. So it's in this no man's land. Eventually, something will break. Either the growth investors come back in and say, yeah, I'm willing to pay 25 times to get that 14% growth for next year, or it'll break down the stock until it is cheap enough for those value investors. So sorry to say, for Etsy investors, it's tough times right here to be in the stock. And that's why these charts are rather shocking because it is such a disconnect with where the earnings are going. Okay, so moving on to the fifth stock. And I might do a bonus one because I had so many choices, I couldn't really decide. So I think I am going to do a sixth bonus stock. But the fifth stock is in an area I know many of you have been buying, and I know you're incredulous that no one else is because they appear cheap. And it's Chinese stocks. It's JD.com. I did look at Alibaba too, but JD's chart is even more shocking than the Alibaba chart. So the ticker is JD, the huge Chinese internet play. It is the Amazon of China. Shares peaked in 2021. I sound like a broken record. It's true on all these stocks. And then it's been the slow slide all the way down. It looks like they might have bottomed in early 2024, but the shares are kind of weak again here. So maybe they didn't. It's unclear. But 5 years, the shares are now down 14.4%. Year to date, they're down, but only 4%. So they're just kind of meandering here. But look at this earnings growth. Still looking good, even though the Chinese consumers pulled back. The analysts are still pretty bullish here. Let's look at these detailed estimates because I'm curious to see what they did last year. So 312 last year, expect to make 340 this year. That is earnings growth of about 9%. That's in line with what we're hearing about the Chinese consumer and how they have pulled back on purchases. It's not totally crushing numbers. It hasn't gone negative, but, that's not as great as what they used to be doing. 2025 up 7%. So that is more earnings growth, but that's what makes this chart so shocking because the PE for this one is at 7.8. So this is a true value stock on a PE basis, and it continues to decline. So it is getting cheaper. And so you get a lot of exasperated folks on the various chat boards, especially on StockTwits about JD.com, because, they're wondering, what is everyone thinking? Why doesn't everyone see what I see? The stocks is cheap and the earnings are rising, and I'm only paying 7 times earnings for it, the largest online retailer in China. But the shares below pre-pandemic levels, and how low will these ones go until they're even more dirt cheap? I'm not sure. But JD.com and a lot of the Chinese stocks are looking like this in these shocking charts. And so we'll see if there's a turnaround or if these are going to meander along as we've seen some of the others. Okay, and so for the sixth bonus chart, I wanted to do a U.S. retailer, Wayfair. I've always been kind of negative on it. because they were always negative earnings and they could not be positive on the earnings front. And that made no sense to me. They were selling tons of merchandise, but making no money. But they seemingly are going to turn that around, as you can see on this shocking chart. So this one peaked as well in 2021. We were all buying desks, lamps for our offices, various other home items, and then we weren't. So not surprising, shares plunged down in 2022. They've stayed down. They haven't gone back to the 2023 lows yet, though. So is that good? I guess so. But what is these shares doing? 5 years now, down 53%. They have not yet retraced this year, 2024, back to the COVID lows, but they look like they were busting out to that in 2022, 2023. So they're off those lows. Year to date, though, now down about 10%. So not a lot of momentum, but look at these earnings. Look at where the earnings are expected to go. Will they go there? If we get a recession in the US, maybe we don't go there. So last year they lost $1.13, expected to make $1.13 this year. So 200% earnings growth. Next year, expecting to make $2.31. So that's another 100% earnings growth. So that's pretty impressive. Sales growth, not so much. 1% this year, 6% next year, but they must have maybe cut costs somewhere. Maybe they have cheaper delivery now. Estimates are being cut in the last week on this one. Did they report already? Let's see. I don't think so. No, they haven't reported as I'm covering this, but they're about to. It's imminent. So when you listen to this podcast, they will have reported earnings. So all of this could change and probably will on the earnings front, could get better, could get worse. Unclear with this earnings season how that's going to turn out. But when you just look at this chart, the massive sell-off, what's happening with the earnings, now it's still a fairly expensive stock on a PE basis. And again, this is one that might be in the no man's land because with the shares around $50, if they're making $1.13, well, they're trading in, the 40s for a PE, and that is not cheap. But you are seeing this strong earnings growth, but it's apparently not enough to lure the growth investors back in here. So this is what I'm going to be tuning into this earnings season and beyond, because I have been following it for quite some time to see if they can make money when it's not the pandemic market conditions. And it looks like they are going to, but can they hold that? We will see. So what do I think about all of these pretty shocking charts? This is an unusual time. I've never seen the price and consensus charts look like this on so many stocks. That 2022 sell-off was the real deal. And it was wicked. And a lot of these stocks are now completely out of favor. I do think a lot of them will move into the value category, but it may take a longer time period. It may take another year or even two to really wash out all of those people who kept coming back in thinking it's cheap enough now. And look at this growth. But it's too soon to know. We won't know until it's over and done with. But these charts do give some buying opportunities, especially if you're a growth investor, because the earnings growth does look good with all of these 6 stocks. So keep them on your short list, watch these charts, go check out the other price and consensus charts on many of these kind of growthy pandemic plays. You can kind of just go down the ARK-K list of its holdings, check out those price and consensus charts on each of them. They all don't look like this bad, but many of them do because growth is out. Maybe value is going to be coming back in. And that means there could be some buying opportunities in some of these shocking charts. So do your due diligence, listen to those conference calls, and keep an eye on some of these because the earnings growth is amazing. Okay, let's recap the stock tickers we talked about. So there was Twilio, ticker TWLO, PayPal, PYPL, Roku, R as in Robert, O, K as in Kathy, but with a K. And U, Roku, Roku, Etsy, E as in Edward, T as in Tom, S as in Sam, Y, ETSY, JD.com, just two tickers there, two letters. Ticker is JD, just JD for that one. And then we had Wayfair. It's just one single letter. It's too cool for more than that. It's ticker W as in Wayne or Wayfair. W as in Wayfair. But that's the added bonus for this one. But you should be sure to subscribe to get all of our podcasts here. Don't miss a single one. Thank you all for subscribing on our YouTube channel to get this podcast and also all of our other videos over there. You can get it at Zacks.com/YouTube. As I said earlier, you can also get us just with the audio on Apple Podcasts. We're on Spotify, Amazon Music, anywhere you can get the podcast, but be sure to get us somewhere. And I'll see you again next week with some more charts and stocks.